I need you to take a deep breath and give me your undivided attention. I am not about to discuss traditional stock picks or quarterly earnings reports. What we are discussing today transcends typical investment strategy. It is an urgent briefing on wealth survival, straight from one of the most respected and aggressive voices in the world of hard money, Eric Sprott. This is not a theoretical exercise in economics. This is an alarm bell ringing about the fundamental integrity of the financial system itself, specifically concerning the two ultimate forms of monetary insurance, physical gold and physical silver. When Eric Sprott, the renowned billionaire investor and true believer in the physical reality of precious metals, issues a warning, the entire physical metals community stops and listens. He isn't predicting a minor market correction or a shift in sentiment. He is signaling an impending, potentially cataclysmic failure in the underlying infrastructure that sets the price of gold and silver globally. Sprott's latest assessment suggests that we are at a pivot point, a critical juncture where the decades-long suppression of metal prices by the paper derivatives market is finally reaching its absolute limit. To understand the severity of this warning, we must first quickly contextualize the macro environment. Look around. We are drowning in debt globally. Central banks have engaged in the largest monetary expansion experiments in history, culminating in persistent structural inflation that governments are desperately trying to define away as transitory or manageable. Real interest rates remain stubbornly low or negative, and the geopolitical landscape is increasingly fragmented and volatile. In any historical context, these are the perfect textbook conditions for gold and silver to soar to all-time, inflation-adjusted highs. Yet the reported prices seem frustratingly range-bound or artificially depressed. This is the conflict, the core tension that Sprott is identifying, the vast yawning chasm between the paper price and the physical reality. The global commodity exchanges, most notably the COMEX, were designed to facilitate efficient trade using derivatives and futures contracts. However, over time, this system has morphed into something far more insidious. It has become a massive mechanism for price suppression, where infinite amounts of paper, contracts promising delivery, are traded, often leveraging the underlying physical supply by ratios that are frankly absurd, sometimes exceeding 100-to-1, particularly in the silver market. For every single ounce of physical silver or gold sitting in a registered vault, there are dozens, if not hundreds, of claims against it. This is not a sustainable structure. It is a house of cards built on the assumption that nobody, especially no major player, will ever demand massive physical delivery simultaneously. Sprott's urgent warning is predicated on the belief that this assumption is about to fail, violently. What happens when the physical demand finally overwhelms the paper supply? What is the precise trigger that forces this deeply leveraged derivative system to break and compel the market to reprice based on true scarcity? And crucially, why is silver, often dismissed as gold's less glamorous cousin, the key vulnerability in this entire system, the Achilles heel of the global financial architecture? These are the open loops we need to explore immediately. Let's zoom in on silver, as Sprott has continuously emphasized its criticality. Silver is unique. It is not just a monetary metal with thousands of years of history as currency and wealth storage. It is also a vital, irreplaceable industrial commodity. The surging global push towards decarbonization, solar energy production, and the exponential growth of electric vehicles has created a structural, systemic demand for physical silver that mining supply simply cannot keep pace with. For years, the market balanced its books by drawing down existing above-ground inventories. That well is now running dangerously dry. Sprott monitors the publicly reported inventory levels in the major vaults, specifically the registered category, which represents metal available for immediate delivery. He has shown, time and again, that these numbers are plummeting to multi-decade lows. The amount of readily deliverable silver is now a fraction of the annual industrial and investment demand. It's a mathematical certainty that this equation leads to a zero inventory scenario, sooner rather than later. The mainstream financial media ignores this, focusing instead on short-term interest rate decisions or quarterly GDP adjustments. But the physical market, the actual miners and refiners, are screaming about scarcity. Sprott is essentially saying, ignore the noise on your CNBC screen, look at the vault doors. They are almost empty. The current pricing mechanism is a grand illusion, maintained by high-frequency trading and the constant rolling over of paper contracts. The moment that illusion is shattered, the moment a major sovereign entity, a massive ETF, or a significant institutional investor says, "We don't want the paper contract, we want the actual metal delivered now," that system grinds to a halt. This isn't theoretical market analysis. This is an emergency situation regarding the security of your capital. Sprott's warning is existential for investors who have placed their faith entirely in fiat currencies or derivative products. If you do not hold physical metal, or have substantial exposure to the companies that dig it out of the ground, you are exposed to a failure of trust in the banking and commodity trading systems that Sprott believes is inevitable. The great revelation here, the climax of Sprott's thesis, centers on the concept of forced settlement. When the physical delivery failure occurs, when the COMEX or its associated vaults admit they cannot meet the obligations of the outstanding paper contracts, the mechanism of price discovery must reset. It is no longer a question of supply and demand leverage of 10 to 1 or 20 to 1. It's 100 to 1. When that 100 to 1 leverage snaps, the price must instantaneously adjust to reflect the true underlying physical scarcity. Sprott suggests that this required adjustment, this market-forced margin call on the entire derivatives complex, will lead to a parabolic movement in both gold and silver that will shock even the most seasoned metals bull. He talks about prices escalating not by 20%, but by factors of 2, 3, or even 5 times their current nominal values, and occurring in a time frame that leaves no opportunity for latecomers to enter the market. The velocity of this impending move is the urgent part of his warning. We are not talking about a modest appreciation of wealth. We are discussing a massive transfer of wealth from those holding paper claims to those holding physical reality. Sprott's message is exceptionally clear. The window to secure real assets at these deeply suppressed prices is closing rapidly. We are moving beyond the phase of patient accumulation and entering the phase of absolute necessity. The current prices are a gift, an anomaly created by systemic leverage that is soon to be violently corrected by the laws of physics and supply. Now that we have established the foundation of this unprecedented physical supply risk and the inherent fragility of the paper pricing mechanism, we must immediately pivot to the actionable steps. The critical question is, how do we position ourselves to not only survive this structural breakdown, but to thrive within the resulting metal supernova? In Part 2, we will dissect the specific financial instruments and strategies Sprott recommends for maximizing returns, how to leverage the coming physical explosion through carefully selected, high-quality mining equities, and what exact precautions must be taken to ensure your assets are truly protected against systemic failure. The time for deliberation is over. The time for preparation is now. The illusion of control is shattering, and I want to be perfectly clear about the imminent risk we face, which transcends typical market volatility. What we are witnessing today is not merely a cyclical downturn or a temporary imbalance. This is the final irreversible fracturing of the system designed to suppress the price of real money. If you walked away from our previous discussion thinking the issue was academic, I must insist you recalibrate that perception. The core warning, the desperate, urgent warning, boils down to the fact that the paper market, the structure we are told dictates the price of gold and silver globally, is now running on fumes, and those fumes are rapidly toxicating the entire ecosystem. The central mechanism of price suppression, the ability of the major bullion banks to flood the market with paper derivatives that promise delivery without ever having the metal in hand, is collapsing under the weight of physical demand. Think about it logically. When you have demand that is exponentially growing, driven by geopolitical risk, currency devaluation, and deep institutional distrust, and simultaneously, you have mining output that is stagnant or declining. You have a supply chain shock that cannot be managed through financial engineering alone. This is the moment where theory becomes terrifying reality. We have reached the point where the cost of pulling metal out of the COMEX registered inventories, the inventory supposedly available for immediate delivery, has become economically prohibitive for the banks themselves, or perhaps more accurately, the inventory simply isn't there in the amounts advertised, in the jurisdiction expected, or in the quality demanded. This vanishing act is not random, it is structural. Every ounce of gold and silver that migrates from registered vaults into deep storage, held by those who understand the permanence of physical wealth against the temporariness of fiat currency, tightens the noose around the neck of the synthetic pricing mechanism. The problem isn't that the price should be higher. The problem is that the price is currently a flat-out lie, enforced by a system that is quickly running out of ammunition. The conflict now is between the infinitesimal physical market and the infinite paper market. Which one governs true price discovery? Historically, the infinitely expandable paper market won, thanks to central bank intervention and leverage. But that leverage only works if there is trust that physical delivery could occur. Once that trust evaporates, and watching COMEX inventories drain quarter after quarter provides the evidence, the leverage reverses, becoming a catastrophic liability for the shorts. The open loop that must be addressed is, what happens when the banks, the large short players, face mandatory delivery and cannot fulfill their obligations? The answer is simple, violent, and swift. Price discovery shifts entirely to the physical market. Imagine the sudden realization globally, across trillions of dollars in paper assets, that the supposed safe haven asset is only available at a price several multiples higher than what is currently quoted on a screen. This is not fear-mongering. This is physics applied to finance. We are observing the acceleration of M2 money supply coupled with the unprecedented global debt mountain. The only way out for governments is to inflate the currency away, devaluing the debt itself. Gold and silver do not just track inflation. They scream about the failure of the monetary system that causes inflation. Consider the context of global debt today, which is not merely burdensome, but mathematically impossible to service under conventional interest rate structures. When the total unfunded liabilities globally are factored in, pensions, healthcare, long-term entitlements, the figures become astronomical. The choice is binary, default or print. Every major economy has chosen to print. When you print trillions, the denominator, the dollar, the euro, the yen, loses value inexorably. This means that assets held outside the system, gold and silver, must adjust upwards dramatically to reflect this monetary debasement. We are not looking for a 10 or 20% gain. We are looking for a complete re-rating, necessitated by decades of suppression and the final exhaustion of fiscal responsibility. This brings me back to the urgent focus. Silver. The gold-to-silver ratio remains absurdly high by historical standards, far above the geological ratio and certainly above the ratio established during periods of honest money. Silver is not only monetary metal, it is an indispensable industrial metal, consumed rapidly in green energy, electronics, and medical technology. Unlike gold, which is mainly stored, silver is constantly used up. This dual function means that the true price discovery mechanism for silver will not just reflect monetary demand, but also a catastrophic industrial supply squeeze. When institutional investors, who have historically focused on gold, suddenly realize they need silver for diversification and its leverage potential, the market is simply too small, too tight, to absorb that sudden influx of capital. The resulting parabolic move will leave almost everyone behind. I want to re-engage with the core warning. The window for acquiring physical assets at these suppressed prices is closing faster than most analysts are willing to admit. We are past the point of subtle indicators. We are watching the final ounces of reliable, accessible inventory being withdrawn. This is not a drill. The true price is not what is displayed on the screen. The true price is what you must pay right now, physically delivered outside of the banking system, and that premium is already widening dramatically in the specialized market for bars and coins. That widening premium is the definitive signal that the paper price is breaking down. The climax of this narrative, the great revelation, is simply this. The moment the mainstream institutional world acknowledges that the COMEX is functionally broken, meaning it cannot guarantee delivery without triggering a default event or a massive political intervention, that acknowledgement will unlock the true, unsuppressed price. This recognition will not be slow. It will be instant, occurring possibly over the course of a single trading week, or perhaps a single traumatic day. The leverage in the system will unwind, forcing those banks holding enormous short positions to cover at whatever astronomical price the physical market dictates. When the short covering begins, fueled by margin calls that cannot be met, the price action will become explosive. The price mechanism will transition from a synthetic, bank-driven calculation to a genuine supply and demand function, reflecting the true scarcity of metals relative to the vast expanding ocean of fiat currency. The payoff for those who hold physical precious metals will be the generational wealth transfer that has been talked about for years. This is the moment where true assets restore purchasing power lost to government monetary expansion. This is the ultimate insurance policy paying out, providing protection and stability as the legacy financial instruments falter under the weight of deflationary debt collapse countered by inflationary currency creation. My final call to action is pointed and uncompromising. Secure your physical metal now. Do not wait for the confirmation that the paper price has broken. By then, it will be too late. The supply channels will have seized up and premiums will be unmanageable. Focus on acquiring secure, allocated physical assets, taking delivery outside of the major banking systems where jurisdictional risk is minimized. The time for waiting for a dip is over. The risk is not buying higher. The risk is being left with worthless paper when the music stops. Act decisively, act urgently, and prioritize possession over speculation. Protect your capital now, before the inevitable. Violent re-rating makes these prices a distant, unbelievable memory.